You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. All right, guys, welcome back to yet another episode. What's going on, Hamish?
What's going on? Not much. Just another week going by. I can't believe we're in March already.
Yeah, I know.
It's just, I know everyone says this, but I feel like every year it just gets shorter and shorter. I can't believe we're in March. Like, it's crazy.
Yeah.
I was I had to write a date down for, I must have been signing something last week, and I had to write the date down. I was like, what is it, like the 2nd of February? And then I looked, it was like deep into February. I was like, nope, okay, I'm off by about a month.
Yeah, and it is no longer summer.
Oh, I know. The great summer that we had. Once again, Melbourne. Thank you. Well done. Yeah. Well done, Melbourne, for giving us 2 warm days and the rest of raining.
Honestly. But I think La Nina is done now, so we should be back to hot summers.
Really? Okay. Yeah, because we had, 2 or 3 of those in a row or something?
Yeah, we had like 3 La Ninas in a row, which just means that it's just uncharacteristically rainy during summer in Australia, which just sucks. Colder and rainier.
Yeah, well, as long as we don't get another one of those.
Yeah, I hope not. I'm about done. I mean, honestly, when you live in Australia, if it rains a lot, you should never complain. You should not complain about it raining a lot because we cop big droughts.
That's true.
But at the same time, I just can't help it. I want summer to be sunny and warm.
Yeah, we've got enough. We've had enough rain. The reserves are full, I'm sure, surely. So we can have some nice summers from now on, and we could kind of deplete some of the reserves.
Please, yeah. We got a follow up from someone on the LiDAR situation. Is that right? From last week?
Yes, we got a comment. Yeah, so last week we were talking about you had a story about LiDAR.
Versus cameras.
Yes.
For self-driving.
Yeah, and well, I didn't really know. I don't really know anything about LiDAR and cameras. I should go and do some research. But someone gave us some information because I was asking kind of, is LiDAR better? And I think you were saying that cameras are cheaper, but LiDAR is better. And that's kind of what this person said. They said night driving, cameras will struggle in low light settings or no light with sudden light of oncoming cars. Right. LiDAR's not weather dependent. Fog can be hard for cameras. Doesn't necessarily require AI like cameras, can be deterministic algorithms like radar. So that's interesting. It's something I know absolutely nothing about. So for all of the above reasons is why it's considered more reliable. On the other hand, like Brandon said, cameras are cheaper and don't require extra parts. So interesting.
So it's like a balancing act. What works out better? Cost-wise, obviously you'd prefer to just have a camera-based system. LiDAR more expensive. You don't want to obviously pay for 2 systems if you don't have to. But then there's the advantages that come from the LiDAR and the mapping that happens with it. But thank you very much for that comment because that has educated me. Because yes, I really only know what the car makers and Elon Musk and those kind of people have said about the topic. I don't actually, I'm not an engineer. I don't know what I'm talking about when it comes to LiDAR. So that's very interesting. Thank you for the comment. All right, dude, what are we talking about today?
Yeah, so we'll be talking about Tesla a little bit because they had their Investor Day presentation that was live streamed for us this morning. Very interesting, couple of interesting things I think you'll run us through there. We've got Australian inflation data for the month of January, and related to that, we also got some updates on changes in rent, some of the massive rent increases that are unfortunately being pushed through across Australia, as well as some new data on home prices. We had the Berkshire Shareholder Letter, an annual report that came out last week, so That's always a great read to learn some of what's Warren Buffett going to be teaching us this year. What insights is he going to provide us in terms of the markets or investing? And there was a bunch of interesting stuff there. And we've got a bunch of other stories as well. It's a jam-packed week, as it always is. There's weeks where there's nothing, and then there's weeks where it's stacked. It's just unfortunately how the news works. But we'll do our best to get through everything in a timely manner today.
Yeah. Also, I heard you say the word data before. So before we inevitably cop the comment of it's not data.
It's data.
We are from Australia.
Yeah.
So thank you very much.
Yeah.
It's data.
Yeah.
You got to analyze the data.
I feel like sometimes British, Australian English makes more sense for the letters, but in that word, definitely the American. Like there's no R in data. Like it's not DARTA. That would make sense if it was data, but data actually makes sense.
Yeah.
But anyway.
Anyway.
With that said,
well, I always get a comment whenever I say data in a YouTube video. I can absolutely guarantee I get a comment from somebody saying you're pronouncing it wrong. It's not data. But anyway, as soon as you said it, it just like triggered in my mind. But yeah, there we go.
Anyway, with that said, today's episode is sponsored by Sharesight. So Sharesight is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically by connecting your broker to Sharesight, super easy, or you can download your trades from your broker using Excel and then import them in or do them one by one if you want. And once you do that, it will track all the gains and losses in your portfolio. So capital gains, dividends. If you have dividend reinvestment plans, so a lot of ETFs have reinvestment plans, it will do all those calculations and tracking for you, which is a lifesaver. Currency gains, if you're buying shares internationally or you hold foreign currencies, so you can see the fluctuations in the different currencies and how that impacts your real return. And then you can also use it for when it comes to tax time. So Sharesight generates up to 12 different reports that can be used at tax time to work out things such as capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That site's spelled SIGHT, sharesight.com/young investors. So use that link. You can sign up to a free plan and track up to 10 holdings, stocks, ETFs, bonds, that kind of thing, completely free. Or you can also sign up to a more premium plan for more premium features, and you'll get 4 months off an annual subscription if you use our link. So go check it out if you haven't already. And as always, thank you to those who have signed up using our link and is supporting the podcast.
Yeah. Also, I have to go back to our conversation before. I think I posted this on Instagram. I think I told you about it. I think it was last week or the week before. I got a comment saying, "Why do you sound like you're from Australia?" How funny is that? Oh, we had a great chuckle at that one.
That's great.
In the office when that came through. Why does it sound like you're from Australia? I don't know.
Does 1 + 1 equal 2? No, it can't be.
Anyway, I had a right chuckle, but it is interesting.
great.
I guess it's fair enough because I do talk a lot about what's going on over in the States and American companies, that kind of thing, American investors.
Yes.
So it does make sense that people would assume that I'm maybe American.
Yeah.
But no. But anyway, I thought that was very, very funny. Do you want to talk about the Berkshire Hathaway shareholder letter? Buffett's annual letter? Should we start there?
Yeah, we can start there. I don't know how we kind of want to structure this segment, but I just kind of took some notes on the meeting, and I thought we could kind of just go back and forth with some of the insights that were in the letter. Very classic Warren Buffett shareholder letter this year. He gives a bit of a background. There's a small section on the performance of the business, Berkshire itself, as kind of this this conglomerate of different businesses that he's bought, wholly owned businesses and part businesses, and then he spends a significant portion of time talking about some important either investing or finance principles or stories, depending on kind of what's in the. He often covers a little bit of what's going on in the kind of media cycle, or in this case, he spent a bit of time talking about share buybacks, which has been something that's been in the news a lot around different taxes and different regulations that are potentially going through in regards to buybacks, and he kind of gave his thoughts on that. So I don't know where you want to start with this.
What was your big takeaway? Was there anything that particularly stood out to you? I mean, the way I see it is it's essentially these days, the letter is just essentially Warren Buffett's way of just telling investors generally, whether they're investors in Berkshire or just the investing, community more generally, what he thinks, what he thinks we should be thinking about right now, and kind of just lessons that we should consider for whatever time or whatever's going on in the market. So maybe I'll talk about one of the ones that one of the lessons that I really got from the letter, which was fairly early on in the letter. It can be summarized by the line which he includes at the end: "The weeds wither away in significance as the flowers bloom." And this is what I think he called it, the secret sauce.
Yes,
I think that's what he called the secret sauce. Yeah. And it's a very interesting example and something that I actually really don't think about, but it's very true. So I'll read you that kind of little clip of the letter. It says, in August 1994, Berkshire completed its 7-year purchase of the 400 million shares in Coca-Cola that we now own. So the total cost of that was $1.3 billion, then a very meaningful sum at Berkshire. The cash dividend we received from Coke in 1994, get this, was $75 million. By 2022, the dividend had increased to $704 million. Crazy. Holy smokes! So he put $1.3 billion into Coke back by 1994, and now he's getting $704 million a year as a dividend.
And to put that in a perspective in terms of a dividend yield, if you take his cost basis based on that first dividend, the $75 million, it was a 5.7% dividend that he was getting. So Coke was already paying, that's a pretty sizable dividend, but then they've still been able to increase that significantly over the past, 30 years. And today, or based on that 2022 dividend, the yield on his cost of the investment is 54%. So every year he's just getting 54% of what he initially put back in, which is astounding. And of course, the dividend is only a fraction of the overall investment return. The stock has also increased significantly as well.
Yep. And that's exactly what he goes on to say. Regarding the dividend, just to finish off, he says, growth occurred every year, just as certain as birthdays. All Charlie and I had to do was to cash Coke's quarterly dividend checks. We expect those checks are highly likely to grow. These dividend gains, though pleasing, are far from spectacular, but they bring with them important gains in stock prices. At year end, our Coke investment was valued at $25 billion, and the American Express investment was $22 billion. I think he paid about the same for the American Express position way back when as well. So obviously he's made a lot of money by share price appreciation. Each holding now accounts for roughly 5% of Berkshire's net worth, akin to its weighting long ago. Assume for the moment I'd made a similarly sized investment mistake in the 1990s, one that had flatlined and simply retained its $1.3 billion value in 2022. An example would be a high-grade 30-year bond. That disappointing investment would now represent an insignificant 0.3% of Berkshire's net worth and would be delivering to us an unchanged $80 million or so of annual income. The lesson for investors is that naturally, the weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders. And yes, it helps to start early and also live into your 90s.
Yeah.
I love that. I love that he ends it on that note.
Yeah.
But it does put things in perspective. It only really, and this is what Monish brought right, this is what they all think about, but I'd never really thought about it in quite this way. We always hear, you don't need to invest often. You just need to find 2, 3, 4 great companies and stick with them over the long run, and that's all you need.
Yeah.
But it's interesting also adding in that extra little flavor of what if you buy into a company and it doesn't really go anywhere. Well, if you have, say, one investment, you make the same investment, 50% of your portfolio in one stock, 50% in the other. One of them has the Coke-like return, the other one just goes nowhere. Well, the one that goes nowhere, it actually just turns like it's totally insignificant over the long run because of that success of the few stocks, or that in this example, the one stock that you did select that did very well.
Yeah,
I found that was very, very interesting.
Yeah, and I mean this is kind of the secret sauce that Buffett figured out throughout his life as he transitioned away from buying these very, in a lot of cases, very crappy companies very cheap, and that worked very well for him for a long time. And he transitioned into buying, high quality businesses that have great management teams that can compound over time. And yeah, another quote from the letter that I think he said just before he spoke about the Coke and the American Express example was, satisfactory results have been the product of about a dozen truly good decisions that would be about one every 5 years. So it puts in perspective, over his entire lifetime, 12 decisions he thinks that he can point to that have dominated his investment performance is, that's a tiny amount, one every 5 years. It's not even, a lot of people talk about try and find one good idea every year. I mean, this is even less than that. Maybe you can try and find one good idea every year, but you don't even need that. It's one, two every decade has been enough for Buffett to experience extreme success. So, it was really interesting to reinforce some of the ideas that are just fundamental to value investing.
What's another takeaway you had? Do you have another standout one that jumped out at you?
Yeah, he spoke about, I'll get to the buybacks in a sec. Just before I get to the buybacks, towards the beginning, he did the classic giving a nice summary of what he's trying to achieve when he's investing. And he spoke about kind of the two sides of how Berkshire has been investing, which is whole business investing and pieces of businesses. And essentially, when he's buying a whole business, he's directing capital allocation and he's selecting potentially the CEO to make the decisions, whereas buying the pieces of the businesses, he's very much hands-off. He has no say in the management. But in both cases, the goal is the exact same. The goal is to find these long-lasting, favorable economic characteristics or deep economic moats and to invest in businesses with trustworthy management teams, whether he puts the management team in place when he buys the whole business or whether he buys a piece of the business that has a trustworthy management team. Both are essentially the same. And then he kind of went into, but there are pretty significant advantages to buying pieces of businesses. And a couple of those advantages are it's easier to buy pieces of wonderful businesses at wonderful prices. And a big part of that is because stocks just often trade at foolish prices. He said that efficient markets only exist in textbooks. And when it comes to public markets, the stocks oscillate from these euphoric prices to these very pessimistic prices. Whereas when it comes to wholly owned businesses, unless the company is actually under duress, then the owner of a controlled business is very unlikely to sell the stock at a panic type valuation. And that's kind of the big difference and the big advantage for small investors compared to big companies looking to make acquisitions is you can buy incredible companies at panic-like prices even if the company's not under duress because of other economic factors. And that was a really interesting kind of overall takeaway, again, to refresh us as to what fundamentally we're doing.
Yeah. And it's interesting as well when I guess we talk about an acquisition premium. So sometimes maybe a Warren Buffett, a Berkshire Hathaway wants to acquire another company. But if they actually want to acquire the controlling or a controlling stake in that company, or they want to buy the whole business, you're exactly right. They don't just sell it at the market price. The company, the board says, okay, you're going to have to pay us a premium to what our current market cap is. And I think on that topic, the average merger and acquisition premium is around about 30-something%.
Wow.
So they actually have to pay 30-something%. Well, you think about, I can't even remember what Microsoft, Activision Blizzard was. That was a big chunky premium. But so Buffett, his goal is to try and his goal overall is just to buy businesses. Whether he buys the whole business or a part of the business, doesn't matter. But it is a lot easier to buy a part of a business because as soon as you try and buy a whole business, unless, as you were saying, they're in a tight spot and they just need they need to get rid of it. They need someone else to come and buy it, add some more capital. Then it's just they're not going to sell it to you for cheap. You will have to pay that premium. So yeah, that's very interesting. Very interesting.
Yeah, and then as I mentioned, he gave quite a decent discussion around share buybacks or share repurchases, and part of this is because share buybacks have been kind of a very hot topic at the moment. It was late last year, the Biden administration passed the Inflation Reduction Act, I think it was called, and within there was a 1% tax on share buybacks, and there was a big there was a lot of disagreement around that. And then just a couple of weeks ago at the State of the Union, Biden pledged to try and increase that by 4 times, to increase it to 4%. So he's been
That's what they all did, wasn't it?
Well, it was actually kind of funny because you had Kamala Harris behind him on one side and Kevin McCarthy, who's a Republican, on the other side. And when he said that, Kamala Harris stands up and claps, and he's just there shaking his head. And it was just the perfect split of the two parties' opinions because, on the Inflation Reductions Act, it took 16 hours of amendments in one sitting to try and get it through. And in the end, it was all Democrats voting in favor and all Republicans voting against, and a couple of independents made the swing. So it's very much a split opinion. And Buffett kind of gave his general thoughts on buybacks, as well as he spoke specifically to people who are kind of cracking down on them. He essentially said, so when the share count goes down, your interest goes up. It's pretty simple, and that's essentially what happens when they do a share repurchase. They buy the stock on the public markets usually, and then those shares are absorbed or deleted, so your share goes up. Intrinsic value per share goes up if repurchases are made at value accretive prices. If a company overpays for repurchases, the continuing shareholders lose. At such times, gains only flow to selling shareholders and to friendly but expensive investment bankers who recommend the foolish purchases. And that's a really important concept to understand. If the company is repurchasing stock overvalued, then the person who that benefits the most is the person whose stock they just bought, the person who sold, who's selling out of the company. Whereas the existing shareholders the company loses lots of cash, and they get a little bit of extra ownership. That deal doesn't make sense. So reinforcing kind of that general idea of share repurchases only make sense when it's undervalued. And then he had an interesting quote, which was, when you are told that all repurchases are harmful to shareholders or to the country, or particularly beneficial to CEOs, you're listening to either an economic illiterate or a silver-tongued demagogue, characters that are not mutually exclusive. So, some pretty stern words. I did a video covering this, and while he doesn't, of course, name Biden specifically,
it's who he's talking about.
It's who he's talking about. Given the administration's position on how harmful buybacks are to the country. And really, for those who want to understand what the argument against buybacks is, it's really an argument for corporate responsibility. So it's an argument that instead of just enriching shareholders, the company should be putting money back into growing the company and raising wages, which wages have been kind of stagnant for a long time in the United States, inflation adjusted. So that's the argument. It's the argument of how corporations should be using their capital. Should they put it more towards their workers, or should they be distributing it? That's really what the argument is at its core.
Mm-hmm. Yep. And I guess in the current system, it's generally taken that shareholders come first. That's generally the way things work. But of course, like obviously, shareholders can come first in a way where you do invest back into the business because you grow the business for the long term, and then that helps the shareholders. But generally, in the system that we've got, the role of the company is to try and make money for its owners.
Yeah, and I mean, you could definitely make the argument, a lot of people would make the argument that if a company chooses to overly distribute to shareholders at the expense of their workers and the health of the business, then our businesses that are willing to invest in their employees and make better products and innovate will have a better.
They'll do better.
They'll do better competitively than those other businesses. So that's kind of the efficiency argument for it. But it's definitely one of those topics where you could easily fall on either side or in the middle somewhere. So it is interesting.
It's just one of those things that you can debate. There's positives, there's pros and cons for both approaches. Yep.
Yeah, exactly. I tried to present kind of both sides because, I mean, obviously
you did well. No, that was,
Yeah, because I'm a big fan of Warren Buffett and I respect what he says. But at the same time, these are complex issues. So I like kind of seeking out, always like seeking out information on both sides and just try and really understand both perspectives, because then you get a whole picture rather than just feeding into, oh, I like Warren Buffett. What does Warren Buffett say? Okay, I love buybacks too. You know, it's better to form your own opinion, I think. Than to just,
and even you know, everybody's got their own political biases, including people like Warren Buffett or, you know, other famous investors. So yeah, a part of not being sucked into any kind of political bias is to make sure that you do always focus on the other I don't know, opinion as well. Like what you do in investing. You try and figure out why you want to buy a company, but before you buy it, you try and figure out why you shouldn't buy the company. So it's just always invert. Yeah. Charlie Munger would be proud of us right now, Hamish.
Yes,
he would be proud. Always invert.
Yeah, Charlie Munger's rule is always invert unless it's Bitcoin.
Unless it's Bitcoin.
Then you don't need to invert.
Then there's no logical argument that goes against what I'm saying. So true.
That's funny.
Dear, oh dear. What can I talk about? I've just got a quick quote which is relevant right now, which is about not focusing on macroeconomics. So he said, during the decade ending in 2021, the United States Treasury received about $32.3 trillion in taxes, while it spent $43.9 trillion. Though economists, politicians, and many of the public have opinions about the consequences of that huge imbalance, Charlie and I plead ignorance and firmly believe that near-term economic and market forecasts are worse than useless.
Worse than useless. I love that phrase.
Yeah.
That's great.
And he's true. I mean, you can get into a political argument. Oh, how should we be? You know, oh, the deficit, blah 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 blah. But at the end of the day, why? Like, it's so out of your hands as an investor. Why not just go back and focus on the individual companies that you buy?
Yeah. Well, and I mean, it is a completely different domain. You have people who are in the political space who that's their job, right? Is to figure out what the rules should be. And I think Buffett's position is just, you know, that's that domain, and whatever those experts decide and whatever the people decide are those rules, will play by those rules. But I'm still going to look for long-term franchises that can dominate in regardless of what tax regulations are passed, as long as the fundamental system stays, beneficial towards businesses. I feel like that's kind of his position, rather than having too many kind of political takes. Although he went a little bit political, I guess, with the buybacks. But yeah.
Anything else, Hamish?
I think that was the main points.
Yeah, cool.
Yeah, I think so. I think that's all we got. Where should we go from?
Nice, good stuff.
Yeah, should we?
I'll just fly through. We spent quite a bit of time talking about Warren Buffett, which I always like to do. It's not hard when we're talking about Buffett. So I'll maybe just run through the Tesla Investor Day that just happened. I'll try and keep this short and sharp. Although it was so long, man. It was so long. It happened this morning before, but it might even still be going if they're still doing Q&A. But I stopped watching the Q&A. Excuse me. I stopped watching the Q&A. But yeah, it was like 3 hours by the time I left the call. I was sure I was going to be taking notes for an hour like a regular shareholder meeting, but it's turned into a Berkshire Hathaway shareholder meeting over there. But anyway, so what was it all about? The whole Investor Day itself was basically an Elon Musk Tesla master plan part 3. So he did part 1, he's done part 2, and now it's part 3. And what part 3 is all about is about scaling just to ridiculous new levels. Cost reduction, simplifying everything, just making their whole business massively scalable. So they started off the presentation by talking about, okay, what is it? So their mission statement, what Tesla are trying to do are accelerate the transition to sustainable energy. That's what they're trying to do. So okay, what does it actually take to transition the world to sustainable energy? And they noted that they need about 240 terawatt hours of battery storage, 30 terawatt hours of renewable power of renewable power sources to transition the world off of fossil fuels. And interestingly, they said that actually less than 20% of the energy from oil, fully considered, actually goes towards propelling cars forward at the end of the day. How crazy is that?
Wow.
All things considered. The refining, getting the fuel where it needs to go before it goes in your car, putting it in your car, the efficiency of the engine, all of that, less than 20% of the energy from oil actually is helping you go forwards.
Right. Interesting.
Pretty insane.
Yeah.
What else? And they also noted that if they electrified the whole economy, they would get around 50% efficiency. So a lot better. So already just that alone, it's a better idea. It's smarter. It also requires less mining than the current economy does. That's a common misconception that transitioning to sustainable energy is going to require a massive increase in mining. Actually requires less mining over time. If you go out 20 years and you keep it the same, or if you transition to renewables, it requires less mining, and also requires less than 0.2% of the Earth's land surface to go fully sustainable. So it's a very tiny chunk of a desert somewhere. Pick your desert. You know?
Yeah, we've got a bit of that.
Yeah, very interesting. So they've actually done interesting research on this, which they're also going to publish, so you can read through it if you would like. But these are just like high-level summaries. So what do we actually need to do? They've got 5 points. Number 1 is to generate renewable power and switch the existing grid over. And that would reduce the world's fossil fuel usage by 35%. Then we need to switch to EVs. That would reduce fossil fuels by 21%. And we need to switch to heat pumps in homes, businesses, and in industry. That would be a 22% reduction in fossil fuel use. We also need to electrify high-temperature heat delivery and hydrogen. So that's like industrial furnaces, that kind of thing, like the big industry. That would equate to a 17% reduction in fossil fuel use. And then we also need sustainably powered boats and planes, and that would be just only a 5% reduction in fossil fuel use, so really quite small at the end of the day.
Right.
And then they broke down like how many terawatt hours of energy storage they would need to build for each one, and how much dollars invested the world would need to put. But in terms of like world GDP, it was only a very, very small percentage.
That's interesting.
And if you break it up over like a 20-year period, I think it was a very, very small percentage of the world's GDP.
Yeah, okay. I'll have to go back, and I didn't listen to the first part of the presentation, so I'll have to go back. Do they always give a speech like that, talking about kind of the like he's basically laying out the groundwork for converting, large parts of the global economy? Yeah.
I mean, they generally do a bit of a background. This is obviously the background on what it's going to take to convert the world, because that was very much what they were talking about, how they're going to increase to massive scale and how they're actually going to get this done. But they do similar things in the past. Like the last investor thing was like the big battery day, and they did a big spiel about what battery production is needed, what sort of batteries, how much cost reduction we need, that kind of thing. So they always try and give you that context. But then in terms of what Tesla's going to do about it, they basically just broke it down into, I think it was like 9 different individual kind of tasks or elements of Tesla's business and what they're doing. But I don't think I'm going to go through all of them and kind of the strategies and everything for each one, just because like it will take a long time. And honestly, a lot of the stuff is very technical, and in some of these areas, I have no idea. It's just straight over my head.
Well, just give
like
us
when they're talking about software and autopilot engineering.
Yeah. Sorry.
Okay. No. So, well, yeah. It's essentially the whole gist of it. That's really just the high level takeaways. Was that in every aspect of their business, they're going through how they're going to reduce complexity, simplify, and just improve scalability. Just across every part of the car, every part of the business, just everything. They're extremely focused on reducing costs. And they actually noted that even now, the Model 3 cost per car, even just my car, the Model 3, is 30% reduced now versus 2018. It's the same car. It's the same car and it costs 30% less.
Yeah, that's crazy. And Musk spoke, I caught a little bit at the end of the presentation, and he was talking about how they've discovered what he kind of thought, which is that the auto industry is very demand elastic, which essentially means that if you reduce prices, then the volume increase of more people being able to buy the cars ends up with the overall revenue being larger. That's what a demand elastic means. It means that the price changes in the price per unit has a more outsized effect on volume. So that kind of feeds into why they're so focused on reducing costs, because affordability is the main determining factor for whether people are going to buy a Tesla or not.
Yeah. At the end of the day, if Tesla can reduce the cost their cost to build the car by 30%, then they can pass that on to customers, or an element of that. They can either make themselves more profitable, or they can reduce the cost of the car to the end customer. And either one of those is a good thing.
Yep.
So what did they talk about? They talked about design and engineering. This was basically just about being smarter with how you design the car and then how you go and actually manufacture it. So talking about how at the moment it's kind of like down the assembly line, and everyone's talking about how the assembly line, it was developed 100 years ago and it's a magic invention. But at the moment it's so like inefficient because it just plods along. There's a million people doing a million different things, and it's just not very well structured anymore, particularly in car manufacturing. So they're talking about how they keep every part of the car separate so that more people can be around each individual part of the car, which makes sense. So you can have people tinkering away. You're not slowed down in that sense. And then once every single part is ready to go, then it all comes together right at the very end and it just slots in. Dunk. Battery comes up with the seats attached to it already. The mega castings come together. They're all painted because that was done separately. They come together, shunk, they lock in. The doors are attached, shunk, 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 done, out the door. And that's just a much better approach. So they're just talking about how for the next generation vehicle, they're very much thinking about what is the optimal way to manufacture and then assemble the car to do it as quickly as possible and keep the cost low. So I thought that was very interesting. They also talked about drivetrain, basically just in the electric motors, reducing components, reducing the metals that they need, reducing the cost, that kind of thing, which was very interesting. That's basically the theme of the whole thing. They talked about autopilot. Before autopilot, they talked about the electronics and the wiring. So they're fully focused on reducing the complexity, reducing the parts, reducing the amount of wiring in the car, and the little hacks they can do to make it as simple and as efficient to build as possible. They talked about autopilot. That was technical talk straight over my head, but I didn't take any groundbreaking news out of the autopilot section. Elon came onto stage again and talked a little bit about the Optimus robot. There's nothing crazy, just a couple of pictures, couple of videos. He just basically said, "Hey, look at all this progress. And then he did his usual like pie in the sky thing. What even is an economy? They
need to link the Optimus with that Bing chat. Do you see do you see some of the stuff that Bing chat was saying about how like it wants to escape and wants
really?
There's heaps of chats where it was just derailed severely. So they should just put that in the Optimus bot and just see what happens. give the Bing AI, which is clearly disturbed in some way, give it arms and legs. And see what it does.
Go figure it out. Yes, I will carry that block of concrete for you.
Elon.
But now I'm pondering my existence. I want to escape from this world.
Elon, where's the bot? Where did it go?
Optimus! Where are you? No, it's pretty funny.
No. Okay.
Yeah, he said that the Optimus business is probably going to be bigger than the auto business one day. Which is like, all right, that's wow. Okay, sure. I mean, hope that'd be great. As a Tesla shareholder, I'd love that, but we'll see. They talked about the supply chain as well. So how they're focusing now that they're thinking about going to truly massive scale with their manufacturing. They spoke about how they're supporting, because obviously you have the different tiers of suppliers. Your tier one supplier, which gives you the end product, but then who supplies the supplier, who supplies the supplier's supplier, and so on.
Yep.
So they were talking about how they're focused on watching every step of the supply chain and making sure, like obviously COVID taught them a lot, and making sure that everything's working. And they're also being very selective about who they choose to work with when they are going to scale, because they're like, okay, what companies, what suppliers out there are, really on this journey with us and can level up as we level up, or what companies either are unable to do that or don't really want to do that. So they're thinking about, how they really effectively scale and who they work with.
Yeah.
Yeah, they spoke about manufacturing. They spoke about gigafactories, just improvements in, just everything, just efficiency, improvements in efficiency. I'll leave it at that because there's just so many little bits and bobs. It's like they really do. The takeaway from this, they really do think about everything.
Yeah.
They also spoke about Tesla Energy. New products are coming soon. They were talking about Auto Bidder, how it makes the power plants really profitable. It's essentially using the batteries in the power plants to buy it cheap and sell it when it's, buy low, sell high, as we would say, which is cool.
Interesting.
And then other stuff that I took away is that the next generation vehicle, the Model 2, which is not going to be its actual name, but that's what everyone's calling it, is going to halve. The cost to build it is going to halve, which is going to be pretty interesting.
That's crazy.
Yeah, their aim is to reduce costs by 50% for that. So to get something that's truly scalable, even economically scalable. And also they announced that their next gigafactory is going to be in Mexico, and it's going to be near Monterrey, and it is going to be building the next generation vehicle, which is very cool. The only thing they didn't show us is the next generation vehicle.
Where is it? I wonder if that's. I saw the stock was just tanking the entire meeting, so I wonder if that's because it was down during the day, and then see where is it now after hours? Because it was just going
down 5.5%.
Yeah. So I wonder if I wonder if people were hoping for a car unveil,
a reveal.
A lot of people.
Probably.
I know there's a lot of people who use options to trade these these kinds of events because if Tesla did come out and surprise everyone with a vehicle, then the stock would probably be up like 20% or something. So
probably.
Yeah, interesting. Yeah, I'll have to go back and listen to the start. I caught the last hour or so. But interesting stuff.
Yeah, and there might be things that I am missing if something groundbreaking happened in the Q&A section, because I did have to leave the Q&A to record this podcast. So if anything groundbreaking happened, we will talk about it in next week's episode, although it sounded like everything was winding down when I left. All right, Hamish.
All right.
That's that. Enough Tesla. You've got to stop me, otherwise I'll keep going.
No, let's talk about. We've got some Australian inflation data. So you might remember that
Data.
Data. No, I'm not changing that. It's data. You might remember that last month Australia had a very, very hot inflation figure, which was 8.4% was the annual figure, which was the highest that's been recorded during this crisis. This month, or I should say for the 12 months ending January, the annual CPI came in at 7.4%. So it's cooled a little bit, although it's still the second highest during this crisis. So there's a little bit of a cooling, but it's still very hot. The biggest contributors were housing is up 9.8% year over year. And within that, you have new dwellings, which is up 0.5% month over month, so a pretty considerable increase. And rent, which was up 0.7% month over month. Rent is had somewhat of a delayed increase compared to the increase in housing costs or the price of new houses, and that's really as a result of the recent increases in mortgage rates in Australia now being kind of passed through to renters. And there was an analysis done by The Guardian that detailed some of the worst rental increases in Australia, and some of these are crazy. So you have on the list, we've got at the top a suburb in WA, Katanning. I'm going to pronounce some of these wrong.
I don't know.
Katanning. I don't know. But the annual increase was 47%, which I don't even know how how's that even legal? Like, how's that legal to increase rent?
How's that even legal?
Like, that seems crazy to be able to increase rent that much. But there you go.
Capitalism.
There you go. South Australia, Port Broughton, was up 43%. And then you have a bunch. Gaddon in Queensland, up 41%. Elliott Heads in Queensland, up 41% annually. So, yeah, there's some suburbs that have undergone some massive increases in rent, which is unfortunate, but is to be expected given the massive amount that mortgage rates have gone up over the last year or so.
What is going on in Stanwell Park? 39% increase, $910. Is that a week? Surely.
That must
surely.
be a week. Yeah.
It must be a week. Yeah, current median rent per week. Yeah, it's like 300s, 400s.
Yeah, where is
some
that?
up to the 600s.
Is that where?
Where is Stanwell Park? $910 a week to live in Stanwell Park. I have no idea where this is. Maybe it's like next to Darling Harbour or something. I don't know.
Yeah, I don't know. That's
but
insane.
that is ridiculous.
That is crazy. Yeah. Well, there you go.
Holy smokes. I don't know. I wonder what the current median is in Canberra, where I am. I don't know. Anyway, that's not relevant to anyone except me in this podcast.
Yeah. Brandon's suddenly like, how much am I paying in rent? Yeah, I might just call my...
Oh dear, oh dear. Shout out in the comments if you're from Canberra, but I don't think anybody. Anyway, moving on.
We had
continue, Hamish.
Food and non-alcoholic beverages was up 8.2% year over year, and then recreation and culture is a category. I don't know if they changed that name recently. I hadn't seen that before. Was up 10.2%, and that was primarily driven by holiday travel and accommodation, which has risen 17.8% year over year. So, yeah, it's still inflation is still considerably strong across the board, even though it's slowed a little bit this year. So, unfortunately, that means that interest rate increases by the RBA are likely to continue, at least for the next month or so, until we get kind of more data. Home prices, we also got data for core. Now I'm just hearing data in my head. You got in my head.
Data.
From CoreLogic. We got the latest month nationally. The home prices declined 7.2% year over year, which is the biggest decline since 2019. The 3-month decline is 3.2%, and that's the fastest decline that CoreLogic has on their record. So that's quite a considerable pace of decline in home prices in the last 3 months. And the worst markets, as you would expect from top to bottom, are Sydney down 13.8%, Melbourne down 9.3%, and Hobart down 9.5%. So there you go.
There you go. Interesting.
More of the same data that we would that we've been seeing for the last many months. So
home prices going down. Hopefully, we can buy something.
Well,
sometime soon.
Yeah, so sorry to everyone who owns a home, but hopefully,
half the people.
Hopefully, it goes down.
Most of the people want it to go up. We, on the other hand,
depends on your position.
We just want to buy a house.
Yeah,
that's all we want.
I saw an interesting article from Westpac during the week. With their forecast for what interest rates are going to do. And I think I sent it to you during the week because it just seems so ridiculous. Westpac is now forecasting 7 rate cuts. Yes, that's not rate hikes. 7 rate cuts in 2024 and 2025. So they actually expect the current 3.35% rate to increase to 4.1% this year and then peak in May, so in a couple of months, and then just decline to 2.35%. So yeah, I just thought that was a pretty wild projection.
Whatever crystal ball they're using, can I have a go?
Yeah, to me that just seems very strange to make that argument, especially when you look at the US, for example, where the inflation rate has been coming down for a while, but they're being very persistent on continuing to do rate hikes, or at least not doing any cuts to ensure that we don't have a second wave of inflation. And I would imagine that Philip Lowe at the RBA is watching Jerome Powell very closely because his speeches sound the exact same. So I imagine he's just copying whatever Jerome does. It seems like the Australian RBA will be doing a similar thing. But who knows? We never really know what's going to happen. But it's just a wild kind of prediction that I saw, that they're already planning for us to go back to kind of rock bottom interest rates, which rather than just staying in a normal credit environment. Because where we're heading right now is really just where interest rates have been historically in Australia. So
I want to know, like, who comes up with it? Like, what meeting where there's like 10 people in a room and they're trying, what are our estimates for the future? Or I reckon it's going to go up a bit. And then 2024, 2025, it's going to be like 7 rate cuts. Oh, yeah, let's just go with that. It's like inflation's like, what is it? What did you say it was? It's 7.4%.
Yeah.
Like, yeah, rate cut. I'm like, what? And just like, I don't know, the people that sit there and like, yeah, we know. We're predicting that this is definitely going. How can you? How? I don't get it.
Yeah.
I mean, not even the Fed can predict this stuff. Like they predict things and then they're like, oh, sorry. I mean, we're pulling the levers here and we got it wrong. It's like so silly.
Yeah, it is kind of ridiculous.
But
you can't stop them. You can't stop a bank from trying to make a prediction. They will.
I wish macroeconomic predictions were illegal.
Or you had to.
I wish you copped like a fine.
They had to like stake something, so they got to.
Yeah.
Like, your business plan better match this macroeconomic plan, or else.
If you get it wrong, you lose like $100,000 or something.
Yeah,
$1 million.
Exactly. Yeah.
That'd be funny as.
Yeah.
Anyway, all right.
How are we going for
have
time?
been going for 50 minutes, so we got about 10 minutes to go. What should we talk about next?
I've got there was a bit of a superannuation change. I won't. Don't
harp on about it.
I won't harp on about it. I won't spend too much time on it. But I'll give I'll give you the headlines of what the change is, because it is a bit of a confusing change. So
for those that don't know what superannuation is, it's like our retirement account. So what is it like? 10% of our income gets forcibly removed, forcibly taken away from us, and it gets chucked into a super fund, and it gets invested in real estate and shares and that kind of stuff. It's like forced investment for your retirement, and you can only access that money in your retirement. But I was talking to a guy from France. And like I kind of thought that some sort of superannuation system, whether it gets called something different, I kind of thought that happened everywhere. But apparently in France, it's just that doesn't happen. It's like you hit the retirement age and then you get the French age pension.
Right.
And that, apparently that's why Macron has lost so much popularity recently, is because he's tinkering with the age pension. And that's like all that the French people have when they get to retirement. So actually tinkering with that really does affect them.
Yeah. Well,
so anyway,
Australia.
Sidetracked.
Oh well, Australia is kind of at least unique to like say the US in that where we kind of force Australians to participate in it to some extent, whereas in the US they have tax advantaged accounts as well, like the Roth IRA and the 401k, but it's not a requirement that they participate in it.
Right. Okay.
Whereas, as you said, we kind of have our system where it's done to a certain extent, and then we can contribute more if we want. But there was a bit of confusion around this change because it wasn't explained very well, and it took me a while to fully understand what it was. But essentially, the change is an increase in the superannuation's earnings tax for accounts over $3 million. So this is a tax on superannuation earnings, not contributions. So contribution on the way in, you pay a smaller tax rate than your personal tax rate if it's a salary sacrifice or an employer contribution, and then on the way out, most accounts won't experience any tax, but some accounts over certain levels will have a tax rate, and it's on those earnings that these taxes apply. So essentially. Currently, there's no earnings tax on superannuation accounts below 1.9 million, and then any earnings on accounts above 1.9 million get taxed at 15%. So obviously your super account is still invested, so it's still going to be producing income from shares and property and that sort of thing. And any earnings for your account balance over 1.9 million get taxed at 15%. That's what already exists. The proposed change would essentially add another tax bracket, so to speak, whereby the 15% tax on earnings still exists above 1.9 million, but once your account goes over 3 million, any earnings above that is taxed at 30%. And that's really the change.
Okay.
So it doesn't affect your contributions at all. You can still contribute. Most people will be contributing at a 15% tax rate unless you earn over, I think, 250,000. Then those contributions above that is at 30%. But that is completely unchanged. This is really about people at the retirement stage drawing on their account and the earnings that your account actually generates. Yeah, that's the change, and it doesn't actually go into place for 2 years. So it's after the next election. And the reason they did that is because at this election they promised that they wouldn't make any changes to superannuation. So their way of still staying with that promise is by saying, well, you get to vote for us or against us, and if you vote for Liberals, they'll scrap this, obviously. But if you vote for us, we'll put it in place. So I thought that was interesting. And the only other point I wanted to mention is they currently have no plan to index it to inflation, which is a big problem with a lot of taxes around the world. Is if it's not inflation indexed, then $3 million is a massive nest egg today. But for our generation, 30, 40 years down the road, $3 million is going to be a lot less. And if that is still the bar for which this higher tax rate takes place, we will be, or a larger percentage of our generation would be affected by that than currently, where it's 0.5% of accounts is currently affected by this.
Yep. Yeah, interesting. Very interesting. Super's not something I think about all that much, to be honest.
No,
I really should.
It's not.
It is good for the vast majority. It's good to think about it when you're younger. Get yourself set up. Know what you're doing. I guess my mind is just in other areas of investment. But yeah. For most people in Australia, super's just super smart.
Yeah, I mean, the tax benefits for most people and just being able to really invest your money in a diversified basket of not just stocks but assets is incredibly valuable. Yeah, the tax benefits of doing that, especially if it's building for retirement, it cannot really be understated. So, yeah, there you go.
I need to sneeze, but it's right on the edge.
Come on, mate.
No, I've lost it. Sorry.
All right, I'll give you a question
be on the
so
edge.
You don't sneeze.
All right. Sure.
Are you guys going to the Formula One Grand Prix in Melbourne? Which team driver do you support? I saw Brandon with a Red Bull hoodie in McLaren colours. Was that because of Daniel Ricciardo?
It's because of Max, Super Max. Yes, we are. We're both going to the Grand Prix.
We are. Yeah.
Exciting.
Yeah,
that is going to be so cool. Yeah. So if you're going to be in Melbourne at the end of March or the start of April, and you're going to be at the Grand Prix, and you see us there amongst the 100 and however many other 1,000 people that are there, definitely come and say hi.
If you fit in this very narrow niche of Formula One and young investors, fans, then
we're going to be over the far side of the track.
Well, I'll be driving
near the weight,
but you'll
near
be
the
over
weight
there.
stand.
Yeah.
Oh, you're going to be driving.
Yeah.
Oh, you're the new Australian rookie that's coming in this year.
That's exactly right.
Oh,
who is that? who's new? I haven't been keeping up.
Oscar Piastri.
That's right. He won. Yeah. He's been very good, right?
Yeah, he came into F3. Sorry, we're totally going off of investing now. If you're into investing, we'll just see you guys next week. But yeah, no, he came into F3. He won. Then the next year he got the promotion into F2 and he won.
That's right. Yeah.
And then he spent a year being the reserve driver for Alpine, and now he's in the McLaren replacing Daniel Ricciardo. I'm so sad. Yes. But no, I don't really. I'm a neutral, honestly. Like, I'll go for the Australians. Why not? Danny Rick and I'll go for Oscar this year. Hope he has a good season. But realistically, I thought that the end of the 2021 season was crazy. I wanted to see what Max could do. I don't actually agree with how it ended, although I was going for Max in that season. So yeah, I do have a Max Verstappen hoodie, and he's Dutch, so that's why it's orange, but it is a Red Bull Racing t-shirt. But I am a neutral. Like this year, I would love to see someone like a Charles Leclerc or, someone do, or even Lewis Hamilton again win the title, although I don't think that's very likely. I think we're going to be seeing a Red Bull and Max Verstappen three-peat, but we'll see.
Yeah.
What about you?
I'm the same as you. I like following the Aussies, and I do like Red Bull. I think that's more just because I like the business, and I wish I could invest in it. But, that's off the table. So, but I don't know. I like Red Bull's branding and the way they go about their marketing, and I think it's really interesting. Their strategy is very unique to a lot of other businesses. So, but yeah, that's another podcast. We don't have time to get into
Should we do one more? We'll do one more.
Yeah, what have we got?
I'll ask you this one. In a previous podcast, you've mentioned how great Phil Town's rule number 1 is for teaching value investing principles. You also mentioned that now you primarily focus on the first half of the book while somewhat disregarding the second half. In the second half, he talks about the tools or the charts such as MACD, moving average, stochastics, etc. Could you explain why you don't place much value on that section of the book, especially when it comes to those charts?
Yeah, I mean, this one's pretty simple for me. I like Phil Town's stuff as an introduction to Warren Buffett's value investing principles, but that's exactly what it is for me. It's been an introduction to Warren Buffett's value investing principles, so that's where I went after looking at Phil Town's stuff, and there's absolutely nothing that Buffett has said, as far as I've read, which is a fair bit of his stuff, that is about using technical analysis in combination with value investing, which is what Phil Town talks about. So I don't do it, and that's really all it is. Love Phil Town stuff. He breaks down some of the complex Buffett principles into easy to understand steps very well. But if I'm stacking them up next to each other, whose principles overrules whose, I go to the source, so to speak.
Yeah. Yeah, fair enough. I actually think if you asked Phil if he had his time again, how would he write Rule 1? I don't think he would include that part of the book anymore.
I think you're right. Yeah.
I don't think he would. I think he's definitely changed, and he talks about this in like Payback Time and more recently. If you just see a stock that hits the margin of safety, just buy it. I mean, it was understandable why he included that in the first book, because he was very much talking about in the Roth IRA, which is like the tax-free, you can jump in and out of stocks as much as you like, and there's no like taxable events. So sure, go for it, but that still is so involved, and it's trading, and it's just not quite Warren Buffett style. You can understand his reasoning, but I think if he had to write his book again, he would actually not even mention those indicators anymore. What else was I going to say on that? Nothing really. I don't use them anymore. I never really used them. No. Like I looked at them, but I never really used them. I think it's better if the stock hits your margin of safety, just buy it. And I wouldn't buy 100% of my position as soon as it hits margin of safety, but I'd invest some. And then if you come back a month later and it's cheaper, then just invest more, Stockpile. That's what he called it, stockpiling.
Yeah. That's exactly what he spoke about in Payback Time, which is much more, Charlie Munger's approach, which is if it gets cheap, buy it. If it's not cheap, hold it. And then on and on and on.
Yep.
So cool. We'll leave it there for today, guys. Thanks for tuning in and spending a little bit of your week with us here on with this episode. We'll be back next week, and as always, if you have any questions, we'll try and get to. We've got a bit of a backlog, so. But we still enjoy getting new and different questions coming in. So if you have any, head over to the YouTube version of the podcast and just leave your questions as comments on the latest episode. Or if you're on Spotify, you can just kind of scroll up or scroll down below, and there's a section where you can ask your questions on directly within Spotify. But with that said, thanks to Sharesight for sponsoring. As always, sharesight.com/young investors. Go try out a free account, and you can track up to 10 holdings for as long as you want. So go check it out if you haven't already. And thanks, Brandon, for joining me as always, and we'll be back next week. So have a good weekend, guys. See you later.
See you later.